Now, at this moment, a company you never even heard of, probably until this morning, is being taken over by the FDIC, put into receivership. It's called Silicon Valley Bank. It's having spillover effects across Wall Street. The Dow down, NASDAQ down, S&P 500 down, all the major indices down. Bank stocks hit hard. This should not terrify people. It's been thought of as a bank run. I have dug into this. I've talked to the experts. Let me explain what's happening here, and this will probably make sense to you. I hope it does, and feel free to call it if you have any questions. Silicon Valley Bank was the home of major tech startups. You'll be familiar with some of the businesses it helped fund. Beyond Meat, Impossible Foods, Bloom Energy, Solar City, Sunrun. It invested in and helped finance a lot of bad tech startups that have had financial troubles. I mean, the Beyond Meat, for example, is in all sorts of financial turmoil right now. Silicon Valley Bank bought a lot of bonds and held on to a lot of bonds in the private sector. If you go back in time to the financial crisis of 2008, 2009, the problem a lot of banks and investment companies had is their portfolio of assets was largely in mortgage-backed securities. When the housing market collapsed and people stopped paying their mortgages and people went under, and they had used all sorts of computer algorithmic models to decide which mortgages to invest in, and they didn't pan out, well, the whole thing collapsed as a house of cards. Most banks now have fixed this by buying into treasuries that are guaranteed by the U.S. government. So the return is not very good, but they're also not going to fail. Silicon Valley Bank did banking with a mass array of technology firms in Silicon Valley, helped them get their financing, held their bank accounts, and bought their bonds. Now we're in this weird situation. We're in a situation a former governor of the Federal Reserve tells me is actually a return to normalcy. In fact, if you talk to people in finance, what they tell you is that suddenly the old rules apply again. The rules they learned in business school and in finance and in economics. Now, what does that mean? Well, we went through a period in this country for about a decade where interest rates were next to nothing, pretty much going to zero. Where they are right now is where they have historically been. The 4 to 5% mark, up to 6%, that's normal. That's how we're supposed to operate. The problem is that we went for so long, from about 2008, 2009 to now, with historically low interest rates. And that low interest rate time coincided with the rise of major technology companies. And because the cost of money was so low, these companies could prioritize growth at the expense of profitability. You didn't need to make a profit. You're a fintech company, you're a DoorDash, you're an Uber, you're a tech startup. You didn't need to make a profit. They were getting so much money in the stock market on their investments. The cost of borrowing money was so low, they were still making money and able to pay their bills without ever worrying about turning a profit. But as interest rates have returned to normal, as they've gone up, the cost of business has gone up for these companies. A lot of them in their structuring, their loans were variable and they couldn't get fixed rates. Some of them did get fixed rates, but they were also making money off the stock market. As interest rates have gone up, the stock market's entered a bear market. They're not able to make money. And a lot of these companies had bonds and might be missing bond payments. And who invested in a lot of those bonds? Silicon Valley Bank. It was so heavily tied to the tech sector. Now that the tech sector is not making the money it once was and is suddenly having to turn a profit, in many of these companies it turns out can't, Silicon Valley Bank was left holding the bank accounts and the bonds of companies that don't have any revenue. It has collapsed now and has been placed into receivership with the FDIC. Here's an amazing stat for you. North of 93% of the bank's $161 billion with a B in deposits are uninsured, which means now that they're into receivership, a lot of companies aren't going to be able to get their money out, or will only get their money out at a prorated rate. A friend of mine is involved in this sector, and he was telling me about a company he is familiar with that used two banks, Silicon Valley Bank and another bank. That other bank, well, it had its trading halted this morning too. All of this goes back to a different company from a few days ago, and that company was started to collapse because of its crypto burden. Regulators are beginning to regulate crypto. Crypto is not returning the rate that people thought they were. And so this other bank began to collapse. Well, that started looking, and people started noticing something was going on with Silicon Valley Bank, which sent out a notice. Now the question is, where else does the fall happen? What other banks close? First Republic is another bank tech companies have used. Its shares nosedive, but it's come out with a statement saying it actually has a diversified portfolio. So what's actually going on here? How big will this spill over? Let's walk through this. A lot of the major banks out there, JP Morgan Chase, Citi, Bank of America, Wells Fargo. I'm trying to think of who else out there. These banks are massive banks. They're national associations. Have you ever looked at your check? Let's say you have Wells Fargo or Bank of America. You see NA after it. That instead of LLC or Inc., NA, that's a national association. It's a financial group chartered under the United States. Special rules apply, and they are too big to fail, according to the federal government. As a result, they can't buy out Silicon Valley Bank. They can't buy it out. They can't buy it out because the federal government doesn't want turmoil on their balance sheets. They don't want financial instability at the top level. JP Morgan Chase is telling people that it's actually contrary to Silicon Valley Bank that was buying a lot of bonds and tech companies. JP Morgan Chase, Jamie Dimon, is forcing his bank to load up on treasuries and cash. The cash reserves at that bank are so massive now, it could probably stroke a check and write a check to buy Silicon Valley Bank, and it wants nothing to do with it. It's focused on cash reserves, thinking we're headed into a recession. It wants as much cash as possible. And the problem here with these smaller banks is they don't have as much cash, and they decided to try to get ahead to try to grow their portfolio. Instead of buying risky or unrisky U.S. treasuries that don't pay a lot, they bought riskier bonds and stocks to diversify their portfolio, and some of them are crashing as the economy slows down. Smaller regional banks are having this problem that national banks aren't, because smaller regional banks are less diversified than the national banks. The smaller regional banks that are involved in tech are worse off than the smaller regional banks that are involved in real estate. The smaller regional banks that are involved in tech that are diversified outside of tech are doing better than the ones that are solely focused on tech. So there's a scale here. The ones that are going to be the worst hit, probably the ones you're least familiar with, are the banks that are solely involved in tech, have been funding tech, rely on tech companies, and they're the ones that are going to be in trouble. They're the ones we're seeing in the stock market today that are having trouble. The ones that are more diversified into real estate and other issues, they're going to be less turmoil for those banks. And then when you work up the scale to the bigger and the bigger and the bigger ones, you have less and less trouble till you get to the Citibanks and the Chases of the world that are so heavily invested in cash. They have massive cash reserves. There's going to be a lot of stability there. The problem now is the spillover effect for Silicon Valley Bank. 93% of the money in it was uninsured. So how do we deal with this? There will be some who want a federal government bailout of this. That should not happen. One of the reasons Silicon Valley Bank and others are in the problems and the turmoil they're in is something called moral hazard. When the government keeps bailing these banks out who have done these sorts of things, not diversifying their positions, it reiterates to the markets and to the investment economy that if they do these risky bets, the government will always step in to bail them out. When the government steps in to bail out a bank like this, it creates this moral hazard of these companies re-engaging in the same behaviors that got them into trouble in the first place, knowing the federal government is going to take care of them. That's why the federal government has to let these banks die. That's why the FDIC receivership needs to work the process and get as much out of this bank as possible. Now, there are some investors right now, as I'm talking, word is coming out, some major financial investors in Silicon Valley are looking to try to bail out Silicon Valley Bank because it does have $100 billion in the bank. That's in deposits. That's other people's money that Silicon Valley Bank is holding. They don't want that to be wiped out. If private sector individuals and companies want to do the bailout, let them. That's different from the federal government doing it. The bottom line here is earlier this week, as several Silicon Valley banks, not just the one called Silicon Valley Bank, began to collapse because tech companies aren't profitable right now with high interest rates, and they're starting to signal they might miss bond payments, and crypto markets aren't on the rise, they're on the decline, and government regulation is coming. There was a real worry that your local bank was going to have trouble too. As we get to the end of the week, the silver lining here is it looks like some of these banks over-leveraged in technology are going to collapse. Regional banks, small banks, the banks that have a specific niche or niche, as the elite say, they're going to have problems. Your local bank that's involved in local real estate deals, local businesses that you have a banking relationship with, they're probably going to be okay. And if you've got the big players, if you've got the Bank of Americas, the Wells Fargos, the Chases, the Cities, they're really going to be okay because they have cash liquidity. It's kind of funny. I was talking to a friend of mine yesterday and was lamenting I don't have a relationship with a banker. I would love to find a small bank with a banker that I can do business with. But you do have to be careful here now because some of the small banks, if they're not diversified enough, if they're too heavily involved in technology, they're going to have trouble. There are a lot of small regional banks that are heavily invested in real estate. They're going to be fine. This is the biggest story today. And I suspect most conservative talk show hosts out of the gate are talking about the Tucker Carlson tapes or something else. But this is the big story of the day. Silicon Valley Bank held hundreds of billions of dollars for tech startups across America. And it is now in federal receivership because it didn't diversify outside of technology. The larger issue here is the tech sector. Facebook, Meta laying people off, Amazon laying people off, Google laying people off. The only one that's not laying anybody off is Apple because it is very restrictive in how it hires. The big tech companies are going wobbly. And if the big tech companies on the surface are wobbling, the smaller tech companies under the surface are really discombobulated. And that's spilling over into this portion of the banking sector. It's a portion of the banking sector that you at least need to be mindful of is out there. You're going to hear a lot of news about this. The one thing I don't want you to do is my initial reaction was doom and gloom and, oh my gosh, we're going to have a run on banks. That does not appear to be the case. As we're here at the end of this week, it doesn't appear to be the case. This appears to be solely restricted to small regional banks heavily focused in technology. If that describes your bank, you may want to reach out to them. Most people, however, it's not. The fear factor that Wall Street was expecting and the cascading spillover effects Wall Street was expecting don't appear they're going to be happening because it's very unique to these 4 or 5 banks heavily focused in technology and not the rest of the sector, at least for now.
Want to be on the show?